Hello. Hope everybody can hear us. I'm Gary Mattson with Mattson Financial Services. With me is Gerald Green. We're both advisors, and we do the Money Mentor Show on Fridays and Saturdays. Saturdays and Sundays. And we're just glad to have you here. Quite a few people have come on in the last 10 minutes, and I mean, it went 300% more. So we're so happy you're joining us. Today, we're going to talk about smart retirement and tax. And what we want to make sure is that you understand this is actually for entertainment purposes only, that if you take any of this advice, you should actually sit down with a tax preparer or a tax accountant or a CPA before you utilize any strategies. These tonight or any others you might hear about there, you want to do that first. So without further ado, here we go.
So what we're going to cover in this presentation is looking at the Tax Cut and Jobs Act that was passed and what basically changed in it, what's still important, and really how does it affect you as an individual. There was a lot of stuff in this when it was passed, and some of it pertains to the masses, and some of it gets very, very drilled down into who it affects. And we want to walk through that, make sure you're looking at everything, not only how it affects you today, but how is it going to affect you for several years to go.
So with that in mind, Tax Cuts and Job Act, the challenge is reconciliation. It's no more than $1.5 trillion over 10 years. There's no cost after 10 years, and most revert back to the 2025 pre-tax numbers, and it sets up winners and losers.
Yep. So basically what that means is, even though this was passed and it had to go through that process, that is Washington, in 2025, one of the things they had to put in place in order to get it passed was it had to sunset. So in 2025, all of these changes that we're working with and are getting used to now go away at the end of 2025. So again, making sure what can we do now and what do you have to set yourself up in place for after that.
Now remember, we have a new administration, looks like it's going to be coming in, and there are going to be some more sudden changes, but either it's going to change if Trump stays in presidency in 2025, or we're seeing more abrupt changes coming sooner than that. So that's what we're going to discuss.
So one of the big changes were these tax brackets. That's the most notable change for most Americans. So take a look at someone, a couple making $233,000 per year prior to the tax law change. That was the 33% tax bracket. So now, after the Tax Cut and Jobs Act, that actually brought them down to the 24% tax bracket. So good and bad there. What it did was it took the personal exemptions, it eliminated those, and it increased your standard deduction. So it made it a lot harder for you to itemize your tax deductions.
And don't forget that when it sunsets in 2025, those deductions that they took away from you, like financial advisor fees, your CPA fees, tax, all of that stuff, that's not tax deductible. Well, they're not going to be tax deductible when they take it back to the old rules. So your property tax and that you can't take off because the standard deduction is $24,000. They're going to take it back, and now you have to exceed that by basically $12,000. That's the standard deduction. What it was before, what's going to sunset back to as it is right now.
So some of the other changes that were very notable in the Tax Cut and Jobs Act is it doubled the estate tax exclusion to $11.2 million per person.
Per person. Yeah, that's good.
That means you have to have an estate of over $22 million before Uncle Sam's really catching wind of you.
The estate.
Yep, for the estate. The elimination of the Affordable Care Act individual mandate and penalty. So now it said that, okay, you don't have to have health insurance, or it's not going to penalize you if you don't have health insurance. It also repealed the miscellaneous itemized deduction, what Gary was just talking about. So the investment fees, those CPA fees, those services that you were paying for that you could itemize and deduct, it really made it hard to do that because you'd have to, for a married couple, you'd have to have over $24,000 in deductions in order for it to to be used as a line-for-line deduction. And then for the 529 plans, it allows tax-favored distributions for elementary and secondary school expenses up to $10,000 per student annually.
That's those education plans that we set for our children and grandchildren. They expanded it between higher learning to include, again, elementary and secondary schools without distributions to those without penalties. Now, charitable deductions change. Some may not have deductions exceeding the $24,000 standard deductions. So some people looked at and said, okay, we want to make multiple year contributions in 1 year and then maybe none the next year so we can actually take that as deduction. The other thing you can do is called a donor advised fund. And this is where you actually donate the money now, you get the tax deduction now, and it distributes to that charity over time. But you're still in charge of those dollars and when those dollars come out. So that's a donor advised fund. Then age 72 and up can take qualified charitable distributions for up to $100,000. You can take money out of your account, send that directly to the charity from your IRA, not through your checking account, but directly to the IRA. Now you've met your required minimum distributions and you don't have any taxes on that. So first dollar's charity could be from your IRA. And then again, you can do up to $100,000 tax-free to do that.
Now, above the line deductions, there are still items available for above the line. So what does that mean? It's that dollar for dollar discount or reduction of your taxable income. IRA contributions is one of them. $6,000 per individual or $7,000 per individual if you're over 50. That's what they call the catch-up. You can contribute another $1,000 a year into those IRAs. HSA contributions, $3,450 for individuals, $6,900 for families. Again, you have a catch-up here of $1,000, but this is after age 55. So that's dollar for dollar, again, deduction from your taxable income. Now, half of your self-employment deductions are also above the line. So the Social Security tax, the Medicare tax, all of those things become deductible on your total gross income, reducing the overall taxes that you would have to pay.
And what is the Secure Act? It's setting every community up for retirement enhancement. That was the Secure Act. It was passed in December of 2019, and it was the biggest retirement legislation change in a decade. It includes a variety of changes ranging from what's available in your 401k to withdrawal requirement changes. And so we're going to go through those with you.
So one of the big ones with that, and again, this is on your on the tab here, you'll see an offer. You can schedule that call with an advisor to go through some of those specific changes. But one of those was the required minimum distributions change. It went from age 70 and a half to age 72. And if you want to talk about how that really can affect your tax plan, your retirement plan, your income plan, go ahead and schedule that call. You can schedule a 15-minute call with an advisor. Brings you right to our schedule, and you can schedule that out for what works for you.
Now, if you're already in the system under required minimum distributions and you start at 70 and a half, because it went to 72, that does not mean if you're not 72 yet, you get to stop. Once you're in the system receiving that, you got to maintain that.
Yeah, excellent point. Now, the pandemic and the taxes. Back in March, we had the CARES Act and economic impact payments. So with the pandemic, Congress knew they had to do something. They stepped up. Economic impact payments, everyone received $1,200.
I didn't, but most people did.
Most people did. They saw if they unfortunately were put on unemployment, the government stepped up and gave increase in your weekly unemployment check because the unemployment was so high and they lost a lot of tax revenue. So we all know this is money that's being spent by the government that eventually is going to have to be recouped.
Paid back. So there's four really tax buckets: fully taxable, tax deferred, long-term capital gains, and tax-free. Gerald, why don't you talk about fully taxable?
So this is money that as it comes in, this is you're paying the taxes on this. So like a pension income, short-term gains, stock dividends, that's based off your total income bracket. So depending on your total income, you're paying dollar for dollar on those.
Now, tax deferred, we're talking about traditional IRA, 401k contributions through work, 403b, 457s, non-qualified annuities, and of course, savings bonds. Now, non-qualified annuities, while the money's in there growing, it's actually growing. And as it grows, you're not required to take any money out of that, even though it's not an IRA. And as that grows, you're not paying any taxes on that. Like if you have an increase in the stock value itself, you're not going to pay taxes on unless you sell that, but the dividends portions you would, which we're going to talk about. So again, it works that way. And the non-qualified annuities, these are after-tax dollars, and they grow tax deferred.
Then we have the long-term capital gains. So these are assets or investments held outside of qualified accounts. Again, those qualified accounts, IRA, 401k. If you've had those assets for more than 12 months, you're not paying income tax on it. You're paying those long-term capital gains. Right now, it's about 15%. Can it change? Possibly. That's one of the risks that are out there, especially with a new administration.
And then we have the tax-free bucket, which is the one that we all love, and that's the Roth IRA. You've already paid taxes on those dollars. You made that contribution or recharacterization from your IRA, and that grows tax-free for the rest of your life. Muni bonds, those are tax-free. You have life insurance. People go, oh, really? If I've got a life insurance policy and that money grows in that policy, I don't pay taxes on it? Nope. That is tax-free if it's paid out as death benefits. And a portion of your Social Security income, as long as you're meeting certain thresholds, will be a tax-free event also. So we look at these four buckets and making sure that you're taking income the right way.
So the problems with IRAs, or these qualified accounts, 401k, 403bs, is every distribution is taxed at your ordinary income tax rate. This may put you into a higher tax bracket, if not now, later on when you have those required minimum distributions. Those RMDs are going to keep ticking up as you get older, and you're going to have to be taking more and more money out of your accounts, including now you've got Social Security income, maybe you've got pensions. So your income is going to increase over time, which means you're going to be paying higher taxes.
And don't forget, this is what we talk about. We talk about a tax bomb. That is, if you've got a healthy IRA and it grows up over time, don't forget that required minimum distribution increases as you increase in age. So again, it starts out just under 4% at the level of 70 and a half, and then it increases as your age increases. So when you get into your late 80s, early 90s, you're looking at that 7, 8, 9%. If you've got $1 million or maybe even $2 million in that IRA, that required minimum distribution is going to force out $140,000, $160,000. That's going to push you into new tax brackets that you're never going to get out of.
Mm-hmm. And as that income goes up, it can also affect some of these other taxable buckets. So your distributions from capital gains, depending on your income level, instead of getting taxed at 15%, they could be taxed even higher. You're talking 20, 25% now, all because you're not focusing, or you don't have that plan to really focus on the income as you age.
So let's talk about an IRA exit strategy. So if anything that comes out of the IRA, number one, we know we have to pay the tax on now. So if the money comes out of the IRA, we pay the tax, and then we put it into the Roth IRA bucket. Now, people ask me, say, well, I've got this required minimum distribution. Let's go ahead and take that and put it into that Roth bucket because I got to pay the taxes on it. I'm sorry, we can't put those dollars or recharacterization those dollars from an IRA to a Roth IRA because they're the forced out required minimum distributions. But then we can, after that required minimum distribution, still take money from an IRA and put it into the Roth bucket as long as we pay the tax now, the year you do that in.
Now, this is the advantages that Gary's touching on. The Roth conversion. It's future income received as tax-free after 5 years. And then you have larger sums of money that can be accessed in case of emergency, such as long-term care, without raising your tax bracket. So now you can really control what you're paying taxes on in retirement. Okay, that's the big key right there. You do get to control what your taxes are in retirement. Required minimum distributions are not required on Roth IRAs. So again, giving you that flexibility. If you don't need the money, you don't have to take it. It can also reduce the size and tax liability of your estate. So that way you're not passing that tax bomb onto your children and grandchildren.
And again, it is tax-free to them also. So let's talk about a married couple who are both age 65. This is me and Nancy after we had our plastic surgery, and I grew a couple inches. We're at the top tax bracket in 2017 of 15%. The goal is to convert $200,000 of an IRA to a Roth IRA. Now here in 2017 rules, the cost of converting that dollars, that 200,000, I ended up in the 28% tax bracket, or I had to pay $56,600 of tax. I'm sorry, $56,000 of tax to convert that $200,000. Now with a change of 2018, 18, 19, and 20, the cost of that conversion is approximately 22% or $44,000. I've reduced my tax because of the tax, what we call reduction, by 6%, and that's an over 20% savings. Now think of this. When's the best time to do that? We were very fortunate that in February, March, and April, we had people that had IRAs that reduced in value. In other words, the market pushed them down. Made sense. Now we're taking money out at a lower rate, paying the tax on it. Now it goes into the Roth IRA bucket, and as it recovers, that loss of 25%, when it gets back to just even, guess what? We don't pay taxes on all that gain. So once again, it's not just harvesting, but maybe maximizing harvesting in very downturn times.
Again, if you'd like to get more information on how we can help you in your unique situation, under the offers tab there, you can click schedule a call. It'll take you to a page where you can schedule that 15-minute call with an advisor to start going over your specific questions and or plan. So surviving spouse taxation. So if we look here, married filing jointly, they've got IRAs of $30,000 income per year. Social Security is another $30,000. So their taxable Social Security is $6,850. So total income, you're looking at $60,000. So now we have a standard deduction of $14,008 with personal exemptions. Again, this was prior to that 2018 Tax Cut and Jobs Act. So their taxable income was $14,150 and an income tax of $1,415. And if you're single, same type of scenario, total income $60,000. You use your standard deduction with your personal exemptions. You have total income or taxable income of $45,003, and you're paying for $7,000 in taxes.
So the reason we're talking about this is that when you're married filing jointly, look at the tax that you're paying. It's much less. But when you lose a spouse, what happens? Well, we want to keep that income the same. How do we do that? We have to increase the withdrawals out of the IRAs so we can maintain the lifestyle that you want to do. The standard deduction drops down. The personal exemption drops down. Now our taxable income scenario goes up. So now we have to pay more in taxes, which means we're going to take more withdrawals out of our IRA. So once again, just doing things that you normally did to say, I'm going to just stay in the same scenario I am now when my spouse passes really affects how much you're going to draw in the taxation of those assets. Thank you.
So how can you apply all of this? So one, the guiding principle obviously in retirement, don't run out of money.
Nobody wants to do that, right?
It's something that you have to have that plan. You have to understand that that plan is a living, breathing thing, that it will changes as legislation changes, as markets change, but you have to be adaptable with your plan in order to not run out of money.
So we advise you always have a written plan of income. In other words, we want to sit down with our clients and show them exactly what the withdrawals are going to be over time, what's the consistency of that, and when will they projected to run out of money. Our goal is to see never, but we've had clients say, I really want to spend all this down. In fact, I had one client say to me, Gary, if I can have the check for the flowers at the funeral home bounce at the last one of our death, perfect. We spent it all. We've taken care of our kids. We did for them. This is all about taking care of us. Or is it that I want to maintain my lifestyle and I want to maximize that to pass on for children and grandchildren? It's your money. You get to choose. But here we have an income plan in place that says we know what's going to happen over time, and we can adjust things and make sure that the written plan fits or changes with your lifestyle.
So this plan here is showing someone with an investment amount of $1 million retiring in 2020 with a monthly withdrawal of $5,000. So they need, by their retirement date, $1,569,000.
Even if they do this, we have now a 19% probability they're going to run out of money. 19%. Even though they have the plan in place, they're showing it, they're going to run out of money.
By taking a look at ways to adjust and have that written income plan and make sure you're taking care of the taxes, you can still have that same investment amount, same monthly withdrawal, but you don't need as much. Now we have a 95% probability of succeeding here. Now we know that the odds are you are not going to run out of money just through careful planning with that written income plan, taking into consideration things like taxes and all the different taxable buckets that you can have and taking advantage of what's out there.
Remember, you can only control the things you can control. We can't control the markets, but you can control the tax liability that you're going to pay. You do have a choice with proper planning. And like Gerald said here, again, eliminating those extra taxes, again, we didn't need that $1.5 million. We actually only needed $1,039,000 because $500,000 in the other plan went away to federal government and taxes. So now we got a 95% probability that we will not run out of money because we're paying attention to the tax man or lady.
So guiding principle number one, don't run out of money. So protection against the tax volatility, you have to look at asset location as well as allocation. So take a look at, do you have stocks, bonds, non-correlated assets such as maybe real estate, commodities. You want to make sure you've got 3 different tax buckets, diversified income sources. We talked about them earlier: the taxable, the tax deferred, and the tax free. And then taxes down, taxes up. Things are going to change, but the biggest point here is that you can control it with proper planning.
Over a few years ago, this is some time ago, I had 2 clients come to us, and they were professors at Michigan State University. Fortunately for them, with their pensions and their Social Security, they didn't need the retirement dollars they save for retirement. So they figured they're going to beat the tax man up. So they paid the taxes one time, took all that money out, and they put it in CDs. Well, back then, we had fairly different rates, 3, 4, 5% growth. And they were paying between $8,000 and $9,000 a year on taxes on money they never going to use. So as the money grew in the CDs, again, it wasn't going to be used. They want to use it for college education for their kids and grandkids. And so they set it up for that, but they're not using those dollars, but they have to pay taxes on it. They got that 1099 INT every year, and they pay taxes on it. We reshifted that bucket to tax deferral because why? They don't need it. Put it in a tax deferred status, so we're not paying taxes on it. It saved them over $6,500 a year in taxes. And she looked at me and looked at her husband and says, "I'm going to sue my CPA." And I says, "Well, why is that?" She says, "Well, somebody should have told me this." Well, the problem is once you ring that bell and actually pay the taxes on it, there's no way to get all that money back into a tax deferred status like she had with her IRAs and 401ks. So we had to reposition that into a different bucket called a deferred annuity. And then she didn't have those taxes. And again, over the next 10 years, we saved over $60,000 in taxes. So understanding the relationship of where your money's at, what you want it to do, and taking advantage of that will reduce your taxes.
Number 2, you don't want to lose your money. We already talked about don't run out of money. Now you don't want to lose your money. So,
well, 117 years ago, this guy named Mark Twain said this: "I am more concerned on the return of my money than the return on my money." In other words, I don't want to lose my principal. I want gains, but number 1, I don't want to lose my principal.
So this is a chart of the S&P 500 going back to July, June, early 2008. And that big red line right there, we all know what that was. That was your crash of 2007, 2008. The market finally bottomed out in 2009. And then this all goes all the way through. It took all the way till 2013 for the market to get back to where it was prior to the crash.
5 years for most clients in the S&P 500.
Now, if you were still working, this was great. You got to be able to keep pumping money into your 401k, your IRAs, and buy as that market was down. But if you were in retirement and you're taking money out either through an income plan or through required minimum distributions, now quite possibly you're taking money at a loss.
More probably, yes.
So what does that do? That adds stress.
A lot of stress to your accounts and to your sleeping at night. You know, we talk about a lot of times having a stress-free retirement. That's really hard when you're seeing money go away in the markets. And we've had people come in and tell us, you know, when the markets were going up in 2000, you know, I took that beating and I stayed with it, and the markets went up and I felt good about it. And then 2007, it did it all again. So when it went down in 2008, I pulled the money out. And then the market started going up again, so they got back in. And when you get in and out of the market and timing it badly, because most people don't what? They don't buy low and sell high. What do? They get out when it's low and they get in when it's high because they're saying it's going to go on forever. And that's what we heard in 2008. There's nothing on the horizon that we don't see. The market should go over 30,000, which it has done recently. But once again, we can't predict what the market's going to do. We need to reduce the stress of your assets in the market as well as maximizing returns.
Yep. So having those different buckets, not only from a taxable situation, but from an allocation position, will allow you to be able to choose when the market does go down again, because at some point it will happen. Now you get to choose where's the best place to take the money from, because you don't want to take it from a loss. Guiding principle number 3 around what we look at, don't waste your money.
Absolutely.
So what we have here is, looking at an average nursing home cost in Michigan, just under $110,000 a year for a private room. That's amazing. The average inflation of that long-term care services is over 4%. So that means the cost of care in 15 years for those people just retiring now that may need long-term care, they're looking at over $200,000 a year in 15 years.
So think of it this way, your portfolio is going up 5, 10, maybe even 15%, but now you got to take out $208,000 to take care of a spouse and the normal living expenses that you're doing for yourselves. How long is that going to last?
Right. So again, another opportunity here to schedule that call with an advisor. Let's talk about these things. Let's talk about how not to lose your money, how not to waste your money, and how not to run out of money. Here at Mattson Financial, we'll have that 15-minute call with you, answer any questions that you may have. But you can go ahead and schedule that call right in the offers tab of the chat box and set a time that works for you and your schedule. That's the end of our presentation tonight. So I hope everyone found this informative. I hope you had some fun. Right? I had fun. It's always fun sitting next to you.
Oh, wow.
But schedule that call. If you have any questions, don't hesitate to give us a call, and we'll get you taken care of.
And we do hope that if you don't see us by the end of the year, you and your family are safe and you have a Merry Christmas. We've actually done very well for our clients this year. And while it's been scary out there with the pandemic, we hope you have a healthy year end and that next year will actually be more of success for your dreams, your goals, and your desires. Thank you for attending.